Hello again, this is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is June 4th, 2020. I have three topics we're going to discuss as we normally do on a daily basis. Our goal and our mission is to keep our clients informed as to what the markets are paying attention to, what really matters most on both the short and long term, to hopefully make some sense of some of the headlines that we see on a daily basis. Today, let's get right into it, and thanks for watching. First topic of the day is the European Central Bank, the ECB, ultimately brought out their version of the bazooka. They announced it earlier and they made a commitment, but they just doubled down on their commitment, increasing their bond purchases and extending it through next year, next summer, 2021, by 600 billion euros. So that really takes their total commitment right now of over 1.3 trillion to support basically all the purchases. And if you take all the purchases right now that are going to be issued, plus all the refis, if you will, of sovereign debt, and take the magnitude of this commitment financially speaking, it translates into an entire year's worth, like from here on out, worth of commitment. So that's significant. It's really calming markets, calming interest rates around the globe, as well as currency markets. So much is to play out to see where they go from here. But in the short term, it's a tremendous net positive, number one, that Europe is doing this and doubling down, showing that they are going to be at the markets basically to support them at all costs, much like we are in the United States. And that coordinated effort ensures that this is, with this recovery continues to materialize, that it will have some real traction on a go-forward basis. Our second headline is China is booming economically speaking, which means, as China, if you think about this, China is ahead of the United States in the global pandemic curve, okay? On every curve that you could think of. And so from infections to deaths to everything else. And they're on the backside of every single curve, from even their employment data is getting better, as well as their retail sales and the economy itself is getting better. And it just is a look through to see on the other side, those that are further down the road, and not just China, but other different countries that are ahead of the United States. Economically speaking, we're seeing healing, we're seeing green shoots, we're seeing that empirical evidence, high frequency data, it's improving day over day. What that means is that there was a major disconnect from where markets discounted future corporate earnings to what actual present corporate earnings are actually potentially could come in at. And so as we get through this, markets will rise on their way back up as they sort of predict what the future could hold here in the United States. So that's where we're seeing the S&P 500 and a few other indices sort of grind their way higher on a day-by-day basis on the short term. And simply because there's a great unknown from what our corporate earnings are going to look like in the future versus where it's discounted, right? The markets are a discounted mechanism on a forward future looking earnings. And so right now there's so many unknowns, but there's so many opportunities out there, and day by day, you're seeing pockets of opportunities, at least the market is, and that's where we're seeing the markets move higher. So it's actually taking a page out of those countries, China specifically, that are ahead of us, and looking through the headlines and saying, wait a minute, there is real economic information, and there's real economic data that is something that it could play into where we are on a go-forward basis. My final topic of the day is the NASDAQ 100. Just hit an all-time intraday high, not a year-to-date high, but an all-time high. And essentially that's the top 100 technology companies in the world. Why that's so significant, I've been reporting this very passionate about that, as I personally believe that this is the largest technological revolution that we've ever seen. In fact, the last 2-3 months has now pulled forward all of that from corporate America to stay at home on a go-forward basis, meaning everyone's going to have to reinvest and rethink technology, because you can work from home and be productive, because you're going to have to use technology even in the employment world. Unfortunately, it's a true fact that what we see is, even going back to when we had 3 people washing dishes and they brought in a dishwasher, new technology, that just replaced a bunch of people labor-wise in the workforce. And we saw technology do this with computers. We're gonna see this as everyone lays off and brings back their workforce. They're gonna be very thoughtful on who they bring back. Therefore, the unemployment rate theoretically could be forecasted to be still 10 million people in the US economy unemployed by year end. it's kind of crazy to think, because the start of this year, we only had 1 million people that were unemployed, all-time lows, historically speaking, on unemployment. And the technology is the gap in this. And the reason why is, if we look at history itself on unemployment, it's not uncommon. In 08 and 09, it took us 5 years to get back to the all-time high of the unemployment rate. And in 2001, 2002, it took us even longer than the 5-year period to recapture sort of fully employed employment in the US economy. And so that's a little history lesson that's going to prove out, yes, we will see initial claims have peaked. We're going to see continuing claims go down, but we're not going to get to the levels that we were in employment as we did the first this year. And that's simply because corporations are using new technology. NASDAQ 100 is a proof of that right now, that the underpinning right now is that corporations are going to look to technology to replace their workforce, if you will. It's happened through the history of time. It's unfortunate, and there's going to be other things that we're going to have to think about from a fiscal and monetary policy to sort of get the workforce continuing to get back to work, because that is 2/3 of the economy, retail America, and against consumers. So that's sort of a big history lesson on economics, what we saw both in the past and what we can see in the future. But right now, markets are looking at this, and it's a very significant, and we're going to watch this, but don't look for, at least markets don't expect new highs as it relates to all-time, fully employed. But we're going to see unemployment come down over time gradually, and that's going to be a sticky process. And it's not going to be a straightforward process either. But don't let that sort of spook you as what needs to happen for markets to continue, a multi-sector, multi-year bull high from this point forward, in the long run. So thanks for watching today. Feel free to share, like, and subscribe. Take care.